Welcome to this week's series of Credent Connect. And today we're going to cover the market events and broad economic activity here in the first couple of months of the year in what has truly been a very unique market cycle. I say unique because post the last presidential election, post that first week of November, the rhetoric started pretty dominantly on potential volatility and economic policy uncertainty and just noise around market activity. The reality of that, however, which is something we talk about all the time, is markets rarely behave in a way the masses expect them to, right? If we all collectively think X will happen, the likelihood of that happening is very minimal relative to something else transpiring. That's why that notion of a diversified portfolio helps, and the idea of being globally diversified helps on that front. And what's been really interesting here in the first 2 months of the year, now, Alicia, I'm gonna send it over to you on this. From an equity market participation standpoint, what has transpired in that didn't think was going to happen category across all market participants has been the performance profile outside of the United States. Talk to us a little bit about that, because it has been fascinating. We have participated in it, right, as a proper diversification structure. Walk us through that a little bit.
So when we look at broad asset allocation, we look at a handful of factors. We look at fundamentals, we look at technicals. Going into this year, I think everyone was really on the bandwagon that domestic equities, U.S. equities, were going to continue to outperform. What we've really seen is that European equities and really just developed international markets have really outperformed well. So it kind of caught us all a little bit off, surprised. The good news is that all of our portfolios are continuously, we always maintain exposure across the globe. So we still have exposure to international. It's not an overweight exposure, but we still have it and we're still participating within that market. Yeah,
great point. It's fair to say, right, full transparency, we were in that mindset that a stronger dollar was going to be a notable headwind for international equities. Yet even that wasn't strong enough conviction to say we will just eliminate it from portfolios. We maintained a healthy allocation, and so far the relative performance profile has been quite dominant in a very positive way. As we look at that moving ahead, Alicia, as we think of the tariffs, and as we think of how those may transpire, we know that earnings drive markets. We know that markets tend to live in that 3 to 6 month short-term visibility. Anything past that, the crystal ball gets a little fuzzy for us as well. What has the earnings season so far given us in terms of confidence about U.S. economy, about corporations, about consumers? So how has that transpired, and what is the data telling us right now?
So when we look at fourth quarter earnings season from last year, what we're seeing is really strong earnings growth. So I believe the average estimate going in was 7. We're looking at 12 to 13% earnings growth, so almost doubled what was anticipated, which is phenomenal. I think market reactions are a little bit muted, though, because we don't have certainty on policy as far as trade and tax and immigration policy. That forward guidance is a little bit muted, but that actually sets us up for possibly, some rallies down the road once we get that clarity. So it's been a very positive earnings cycle, and, we prefer equities to fixed income, and we continue to do that.
Absolutely. I think our stance from the beginning of the year was that there is excessively more risk, rather, in fixed income bond allocations than equity market participation thus in 2025. And we do maintain that same belief. The earnings backdrop has been tremendous year over year, thus far here 2 months into 2025. And the beauty of that has been that the backdrop of the labor market has actually failed to show those true cracks that were anticipated from that lagging higher interest rate monetary policy environment. So as we look at that collectively, as we look at that holistically, as we gauge where we should be invested over the next 12 months, equity market participation as a function of consumer sentiment, their ability to spend in a very fiscally responsible way, that data looks very welcoming. It looks supportive of that allocation. And we are certainly looking to take any advantage we can along that front, whether it be domestic or internationally, to essentially try to remove more of that interest rate risk for equity market participation. So stay invested. Focus on the financial plan. The noise will likely increase over the next 2 to 3 months because the tariff discussions are going to amplify. However, its impact to earnings, to consumers, to inflationary trends, that data as of right now gives us minimal need to pause and reevaluate, but we're certainly doing that on an ongoing basis.